All right, good afternoon. Thank you for having me here. I'm actually flattered to be part of this panel. I think I was only asked to participate because I'm Sloan alumni, but when I look at the accomplished folks up here, I'm honored to be included. So I'm going to give a quick introduction to what my team does and how we fit into the larger Fidelity organization. Fidelity is a big shop, as you probably know. As I said, I'm the head of quantitative research for the equity and high income division. So within the equity and high income group, we actually manage $800 billion, which is a pretty sizable number. My team, what we do, and I have a team of quants that work for me, and our mission is actually, we're part of the general research process, right? So we do manage some money quantitatively on my team. We have a handful of portfolios that we manage. But really our job is to interact with the portfolio managers to provide quantitative research to them to enhance their process. So that's what my team does. I should say we do it from the alpha perspective. In other words, we help them generate new ideas and build models to pick stocks. But we also do it from a risk perspective. So we had some of the risk folks up before. I think technically I may be also the head of equity and high income risk for Fidelity, even though that's not necessarily my title. So we do all the above. And I say that just to set the context for what we do. What I'm going to talk about today is what we're doing, though, along the lines of, I don't know if I'd necessarily call it big data, but I know the panel today is on innovation, big data, and analytics and finance. So I have big data in my title in quotations, but what we're doing along these lines is not necessarily big data, although sometimes it could be. But Fidelity is doing in other parts of the business some work in big data, whether it's in the marketing and distribution side, or it could also be on our trading desk or an asset allocation. But I'm going to focus on what we're doing within the equity research group. Which is why you see it here. So like I said, it may not necessarily be big data, and I mention this because what I want to stress to everybody is that what we are doing has a long-term investment perspective. We are long-term investors. We tend to have moderate turnover in our portfolios. It's really only about 60 to 70%. And I mention that because what we're doing from a big data perspective may be a little different from what you might expect from hedge funds or some higher frequency traders. Although BlackRock, it was good to hear what you guys are up to. It's always nice to see what the competition is doing. But what I'm going to talk about here is going to be somewhere along the same lines, because really what it is, I'm going to talk about the initiative that I was asked to lead a while ago, which is kind of along the same lines. So the first thing I just want to quickly walk through is the mission and goals. I spent some time in the Army, actually, so I like to have a mission statement. So the first thing I have here is just the mission, and I'll quickly walk through this before I get into some of the other details. But really what we're trying to do, as I said, it's a research focus, right? So what we're trying to do is enhance the stock picking and fund performance of our funds through previously unexplored data sources and techniques. That's what we're trying to do, and that's why I think it's related to what we're talking about today. Today is a conference on data and analytics and risk in finance. That's what my team does, and I want to talk about what we're doing on this new front within the equity research department. The goals here are pretty straightforward. We want to provide actionable intelligence to our portfolio managers, and they need to be easy to understand. They need to be reliable and easy to interpret. Fidelity is not a quantitative shop. There are plenty of quantitative investment shops out there, but Fidelity, like T. Rowe Price, it's not an entirely quantitative shop. We have a pretty strong quant presence. And my team is very much integrated in the investment process, and we manage money. But we have to be able to communicate these quantitative concepts to people who are not quants. So that's very important. The third bullet, and I'm going to stress this a little bit more as we go along, because it's from a technology perspective, which is like practically what this is all about. I'm an investment quantitative research type, but I probably spend 20% of my time thinking about technology problems and data quality issues, which is just a necessary evil because quant is the bridge between technology and investments, and you just have to spend a lot of time thinking about that. But we have to build techniques that can be reused, expanded, and scaled. And then finally, as with all big projects, monitor the costs and benefits of the pipeline. I do want to stress what it's not. It's not a standalone signal or model. We're not trading our own portfolios on these. These are not used to manage small hedge fund type products. It's an input to the research process. So to some degree, I think similar to what Garthy talked about. It's not frequent trading. As I said, we are long-term investors. We have relatively low turnover, and it's not a frequent trading tool. And then I also want to say it's sometimes unstructured data. Often it is, but it's not always unstructured. I know some people get hung up on the phrase big data and whether or not it's big and whether or not it's structured or unstructured. Sometimes it's big, sometimes it's unstructured, sometimes it's not. So that's what we're trying to do. I have this martini glass, is what we call it, the martini glass diagram, to really talk about the process, right? So you see the top of the glass, we have all these different data sources that we can take in. And I have all these different bubbles here, which are different types of data sources which we could possibly take in. You know, you see satellite imagery there, which is a pretty neat one. In the old days, fundamental investors would go out and count cars in parking lots. I think they probably still do that. Nowadays, you can get satellite imagery, which can tell you how many cars are in parking lots. And so, you know, one of the things we want to do some research on is figure out if we can get that data, is there any relationship between cars in the parking lot and future sales growth? So that's one element or one data point that could go into this. You know, I don't have them listed here, but there could be specific company data sources, right? It could be Amazon, it could be Google, it could be LinkedIn. These companies have scads of data, as everybody knows. We're actually not using any data from any of those companies right now, but the other big one is Twitter. We've heard some people talk about Twitter already. I know, Andrew, you've got your research poster outside using Twitter data to see if there's any relationship between that and Fed meetings. And that's something we've actually spent a lot of time looking at as well. But what you see here is the data feeds into a technology infrastructure. This actually is way off scale because we only have one little pawn there for the technology. It should actually be a big infrastructure because there's a lot of people working on this. The technology is almost the most important thing. As I've been working through this more and more, there's a lot of neat analytical techniques. There's a lot of really fun research you can do. Getting the technology infrastructure right is hugely important. From here, we have the quantitative analyst, and then the fundamental analysts and the portfolio managers. But this is all kind of, it all kind of works with each other, right? The quantitative analysts will work with the fundamental analysts to figure out what sort of research they want to do. And then it all feeds into the portfolio managers as part of the investment process. Excuse me. I want to highlight another example that came from the fundamental analysts that's related to the Twitter stuff I just mentioned. You know, we had our restaurant analyst actually wanted to do some work on Chipotle. Chipotle, as a lot of people in the room probably know, face some real difficulties in their restaurants. So this particular analyst wanted to take a look at the Twitter data and what that looked like through time. What were the trends like? And a lot of times we do this work on Twitter. We did it with the Chipotle data. We also did it with McDonald's to look at the launch of the all-day breakfast, which was another interesting piece of analysis. And it's part of the investment process, the research process, to help inform what the analysts are doing to feed into what the portfolio managers and help them make the decisions. So that's kind of how the whole process works, or how we think about it, in this case with a martini glass. So moving along here, I want to talk about some challenges and then some other considerations that I know we wanted to talk about in this panel. In terms of challenges, I mean, it's 2016. There's a lot of data out there, and there's a lot of people trying to sell you data. As well as new tools and things you can use in the investment process. We're Fidelity. We have a lot of resources, which is a luxury, but it means we have to meet with a lot of different people to see if there's anything there. So we spend a lot of time doing that. And there's a lot of uncertainty around whether or not the tools work or whether or not there's anything in the data. Anybody that has worked with this data knows that it takes a lot of effort to transform this messy data into useful insights. That's part of the challenge, although it could also be part of the fun, depending on what your perspective is. These last two are kind of specific to what we're doing. Right now, the effort is still sort of in a tiger team stage. We have some quantitative resources. We really have more tech resource to help us make this happen. But we have to. I have to help manage the demand for these resources to get through everything. All of these are challenges. But the last thing I would say is this is new stuff. It's new stuff. I think that's why we're talking about it today. There's new data, new analytical techniques. And you have to get people to be on board with these things. So another challenge for me is just to really integrate this stuff in the investment process. I think that will be critical to its success. and it's something I'm going to have to make sure we make happen over the next several years. So those are challenges we're going to deal with, and I apologize for all the coughing. I'm still getting over something. I want to talk lastly about some other considerations. I talked about how we're doing this more from an alpha perspective, right? We're trying to use these data sources to identify good stock ideas to put in the portfolios and generate excess returns for the shareholders. We're not so much thinking about risk modeling. I mentioned before that is my purview, but we're not so much thinking about that yet. However, we've done a little bit of looking at this. We've looked at the news sources that can be processed through natural language algorithms to come up with sentiment indicators. We've looked at some of that for alpha. We've looked at some of it to see if they're risk factors, if you can include them in risk models. They do explain the variance of returns to some degree, although we found that it doesn't add much more above the more standard, commonly used risk factors. From a risk perspective, though, we have done some neat work to look at other text analysis signals where we found that it can potentially signal a blow-up coming, which is another potential way to avoid risk. So we are doing some thinking about risk, but it's more to enhance the alpha process. The second bullet, I haven't talked so much about machine learning and data mining. Those are obviously analytical fields where we can apply to these data sets. I think that they're promising areas for research, but we need to make sure that they can be used for long-term investment returns. And it doesn't necessarily have to be 3 or 5 years. A lot of these signals tend to be very short-term in nature. The news data, as an example, I mentioned a moment ago, you can make some money off some of the news data if you can capture the sentiment in the news, but it's very short term, and we need to make sure we can use these things in a longer term process. The second thing I would say is some of these tools are very nifty, but instead of prediction, they can be very useful for explanation. A basic data mining tool, I think, I would refer to as principal components analysis. Principal components can be tough because you don't know what the factors are. They're statistical in nature. You can put them in a risk model, but you may not know necessarily how to use them or explain them to a portfolio manager to understand their risk out of sample. But they can often really help you understand what's going on in the markets to explain as opposed to predict. I can briefly talk about, for a moment, about digital currencies. I think I'm doing okay on time here. Time's up? Okay. I'll skip the digital currencies. The last thing I'll say, though, and I hit this before, the dedicated technology and data quality resources are absolutely critical. Any sort of quantitative effort, I think anybody in the business knows this, you have to have good tech resources. And so I would stress that it's an important consideration and a challenge in any of these sorts of initiatives. So that's what we're doing at Fidelity. It's exciting stuff. From here, I'll turn it over to Sandy, unless you want to introduce him, Andrew?